Capital gains taxes, the uninvited guest at your victory party. You nailed the investment, but here comes the tricky part, making sure you don't have to hand over more than you have to the tax man. Luckily, there are clean, smart, and surprisingly fun ways to protect your profits. Today, I'm going to show you how. Let's go ahead and dive in. Before we get into the strategies, let's first decode what capital gains taxes actually are and why they exist. So what exactly is a capital gain? In plain English, a capital gain is just the profit you make when you sell an asset for more than you paid for it. Buy a house for 300 grand, sell it for 400K, congratulations, you just made $100,000 of capital gain. Buy 10 shares of Apple at $100 each and sell them at $180, congrats, that's an $800 gain. And yes, the IRS absolutely wants its cut of that profit. But there's more to the story. Short-term or long-term? Here's where a lot of people get confused. Not all capital gains are taxed the same way. There are short-term capital gains and there are long-term capital gains that are taxed completely differently. Short-term capital gains apply if you hold the asset for less than 365 days, less than a year. These are taxed at ordinary income rates, meaning you'll pay the same rate as you do on your W-2 or your 1099 salary. Depending on your bracket, that can be as high as 37% or as low as 10%. But long-term capital gains taxes apply if you hold the asset for more than a year. These get a special discount. Rates range between 0, 15, and 20% depending on your income. In other words, if you can just wait and be patient, you'll likely save. It's the IRS's weird way of rewarding you for staying committed to your investments. But why are capital gains taxes a thing? Why do they even exist? Capital gains taxes exist because in the government's view, profit is income, and it believes that a portion of income should contribute to society's shared costs like roads and schools. Not everyone believes that capital gains taxes should exist, but for now they definitely do. They're also meant to encourage long-term investments by taking profits at different rates than regular income. Now let's move on to the actual fun part. How do we actually avoid capital gains taxes completely legally? The number one strategy for avoiding capital gains taxes is the buy and hold strategy. Patience does pay, literally. The easiest way to minimize capital gains taxes is to simply hold your investments for more than a year. This turns short-term gains, taxed at up to 37%, into long-term gains taxed at 0, 15, and 20%. It's the government's way of saying, if you don't day trade yourself into an early heart attack, we'll give you a discount. But for some, this is not just a tax strategy, it's a lifestyle. Warren Buffett didn't get rich flipping stocks every week. He bought, held, and waited. So if you act like Warren Buffett, you can avoid a lot of capital gains taxes. But number two is the 1031 exchange. If you're selling rental real estate, you can defer your capital gains taxes through something called a 1031 exchange, named after the Internal Revenue Code section 1031. Here's how it works. You sell one property, and instead of taking the cash, you roll it directly into another like-kind property of equal or greater value. So, for example, if you own a duplex in Miami, you might sell it and buy a triplex in Fort Lauderdale. This would be a good 1031 exchange opportunity. By doing this, you don't have to pay taxes right now. The gains are deferred until you eventually sell the triplex without reinvesting. You can keep doing this again and again, by the way, kicking that tax can down the road, potentially forever. In fact, real estate investors have an expression for this approach. It's called swap until you drop, and it means you just keep 1031 exchanging and defer capital gains taxes until you die. You might be saying, Karlton, that's crazy, but this strategy can be a powerful way to grow wealth while legally minimizing taxes over the long term. It's like saying, no thanks, Uncle Sam, I'll pay you later, much later. Pretty awesome, right? But step number 3 is the step up in basis provision. It's morbid, but true. When someone dies, their heirs receive their inherited assets at a stepped up basis. Translation: if grandpa bought a house for $100,000 30 years ago and it's worth 600 grand when he passes, the heir's new cost basis becomes 600 grand. This means if they sell it immediately, there's no taxable gain. Awesome, right? Estate planning attorneys love this one, and for good reason. Many of the wealthiest families in America actually use the step-up in basis provision of the tax code to completely mitigate capital gains taxes while passing properties from generation to generation to generation to generation. This is part of how they build generational wealth. You should pay close attention to this strategy since the wealthy use it so frequently. And rule number 4, or strategy number 4, is using Roth IRAs or Roth 401ks. When you invest inside of a Roth IRA or Roth 401k, your money grows completely tax-free. Yes, you pay taxes up front on your contributions, but once that money is inside, all growth, all dividends, all capital gains are yours to keep forever. No capital gains tax no drama. It's like having a little tax-free oasis in the desert of government paperwork. I love it. And the best part? Withdrawals in retirements are completely tax-free too. That means when everyone else is worrying about how much the IRS will take from their nest egg in retirement, you're sitting back sipping something cold and keeping every penny of your profit. Oh, I love it. Plus, Roth accounts, they have no required minimum distributions, giving you total control over when and how you tap into your wealth. Whether you're investing in index funds, real estate ETFs, or even dividend-paying stocks, a Roth is your golden shield against the future tax hikes, because once you're in, the government can't touch your growth. That's the account I love the most. It's the closest thing to a set it and forget it strategy for tax-free growth we have. Number 5, let's offset gains with losses. Tax loss harvesting, for example. Each investor has a few losses in their portfolio. So with tax loss harvesting, you sell investments that have lost value to offset gains from other investments. The key word here is sell. The loss only counts once it's realized. So for example, if you made $10,000 selling one stock, but sold another one at $8,000 loss, you only pay tax on the net $2,000 gain. Even better, if your losses exceed your gain, you can deduct up to $3,000 per year against ordinary income and carry the rest forward. Just watch out for the wash sell rule. If you buy back the same or nearly identical investment within 30 days, the IRS won't let you claim that loss. In short, turn your L's into tax W's. Now, here's number 6. Take advantage of the primary residence exclusion. I don't know why more people don't do this. If you're selling your primary home, you can exclude up to $250,000 of profit from capital gains taxes, or $500,000 if you're married filing jointly. But here's the catch. You must have lived in the home for at least 2 out of the last 5 years that you owned it. So yes, that means that if you're strategic and maybe move every few years, you can keep pocketing profits tax-free. It's one of the most generous tax breaks in the US. Plus, this exclusion can be used multiple times over a lifetime. As long as you meet the residency requirement each time, it's a powerful tool for homeowners looking to minimize their capital gains taxes, maximize their growth of upgrading, downsizing, or relocating. And number 7, giving it all away. If you donate appreciated asset like stock or crypto that you held for more than a year to a qualified charity, yes, you can avoid capital gains taxes entirely and claim a deduction for the fair market value up to the IRS limits. You get to be generous and keep the IRS off your back. I like it. It's a win-win, and possibly the only time you'll feel good about giving away money. This strategy works especially well for assets that have skyrocketed in value, letting you make a bigger impact without having to pay such a hefty tax bill. Plus, it can simplify your portfolio by offloading positions you might have been holding on to for years. And step number 8, move to a tax-friendly state or a county. Some states like Texas, Florida, and Nevada don't have state income tax or capital gains taxes at all. If you're living in California or New York and you're tired of handing over chunks of your profit every single year, moving could literally save you tens of thousands of dollars every single year. Even a partial relocation, like establishing residency in a no-tax state while keeping a foot in your current city, can provide big savings. And over time, those tax-free gains can compound into serious advantages for your wealth. Next strategy is opportunity zone investments. Uncle Sam's favorite neighborhoods are investing in qualified opportunity zones, which are certain economically distressed areas that allow you to defer and potentially wipe out your entire capital gains taxes. Now, you can invest in a opportunity zone by rolling your capital gains into a QOF, or qualified opportunity fund. You can defer capital gains taxes for up to 5 years from the date of reinvestment into a qualified opportunity fund, replacing the previous fixed deferral period for investments made after December 31st, 2026. Pretty awesome. And a 10% step up in basis is granted if the investment is held for at least 5 years. And if you hold the new investment for between 10 and 30 years, your gains can be completely tax-free. What gains, Karlton? Capital gains. That's right. It's like the IRS saying, help me rebuild this neighborhood and we'll forget all about that other thing that you had, that capital gains tax. Now, there is substantial opportunity to build tax-free wealth in opportunity zones. They choose an appropriate name for these areas, but the big picture is to play the long game. I mean, I really came on here to say that. The key to minimizing capital gains taxes isn't about trickery. It's just about strategy. You're going to have to hold assets longer. You're going to have to use tax advantaged accounts. You're going to have to reinvest your money wisely. And and more importantly, plan your exits like a pro. You shouldn't be doing this by yourself. The wealthy don't get rich by guessing or paying fewer taxes because they cheat. They just know the rules better than anyone else and they play them to perfection. By watching this video, you're learning how to win the game too, and we will get this done together. My name is Karlton Dennis. That is all I got for today's video. I really hope that you enjoyed today's video. Don't forget to like, comment, and subscribe to our channel, and I will see you on the next video that we put out. Cheers.